Hey guys, welcome back to another episode of Jack of All Trades. Kalen here with David helping me out. Today we're going to go over just a little bit more of like kind of the current market action. We're recording this, what do we, end of February 2021. So the past couple of weeks, we've had a little bit of a sell-off going on in the markets. I know David's done a bunch of research on bonds that he wants to talk about. Bitcoin's kind of been selling off the past couple of weeks, so we're just going to kind of try and touch on the overall market sentiment right now because it seems like this is the first time in basically in the past year that we've really had any sort of quote unquote real pullback in the markets where people are starting to ask us a lot of questions. Like why aren't my longs going as far as they usually do, sort of things. So we'll just kind of go into that a little bit. So, David, you want to kick this one off?
Yeah, I just want to mention as we were talking how I got out of my short position, freaking Bitcoin started to drop. These things, man. Yeah, so yeah, because I think both of us may have been getting questions lately. So I know a lot of people are just like buying the dip and selling the top like throughout a whole bull market. Sure, that works, but right now we got a situation where we're pulling back hard and we might be even going sideways for a little bit. And so like this kind of goes into the other thing I wanted to talk about today too, which is portfolio construction, right? Because it's important to have a little cash on the side. Because during this whole week, during the pullback, I'd actually been watching support levels and actually bought back in on some positions like Tesla and Nvidia where I was waiting for a pullback to get in at a better price. So yeah, I think that part's like really important. But like the most important thing I think for people to realize is that price doesn't continuously go up, right? So like you need to learn to cash out, keep something on the side, and like I know a lot of people don't want to put the time into like figuring out the macroeconomic factors, but it's really important. I think even for traders, right? Because right now you're finding it hard to kind of get your trades going because the market's not moving in a momentum stage anymore, right?
Yeah, I know you and I were talking about this on the weekend. Like I was asking you about because like obviously you're just kind of teaching me a little bit about how to trade Bitcoin futures and stuff like that. But I was asking you, I've been looking at the charts the past week, and I was like, I haven't really seen anything in Bitcoin that I want. I was like, how many trades have you made this week? And you said you only made one trade this week so far, and usually you do quite a few. And then I said, yeah, even on my normal stock trades, I only made one trade this week because I just didn't see anything else. Nothing was really doing what I wanted it to. So I think that's kind of an important thing for people to realize too. Is you don't have to trade every day. Like David and I have been doing this for years, and both of us are doing completely separate things, and both of us just happen to only trade once because that's all we saw, right? So it's the age old thing. The market gives what it gives. You don't have to play everything. Just keep your focus down. And I think one of the things too I want to mention for anyone that's been investing or swing trading or just buying or day trading or like whatever you've been doing, if you have kind of been starting just in the past year and you've having pretty good success, I would say now is probably a pretty good time to, hopefully you've been saving some of the trades that you've been doing, but I would say go back and take a look at, some of your biggest winners, some of your best movers, and start to kind of dissect them a little bit more, because like what you're going to find is if the markets do turn where they start selling off or going sideways, what you're going to find is probably, at least half of those trades that you made won't necessarily work out the same way. So you want to find whichever ones were the biggest movers and really just compare all the factors in between those specific trades. If you got 20 or 10 trades or whatever that were huge movers compared to, a half dozen or a dozen of the other ones, then take a look at those and see what the main factors are, see why they went so much further, and try and start setting up like a really strict criteria for yourself, because you're going to want to be much more choosy when you get into sideways markets or bear markets.
Yeah, and I'm going to go into explaining the bond thing because a lot of people have been hearing in the news like the bond market, the yields are going up, so the stock market's selling off. I actually spent like 2 full weeks before this happened reading into this stuff, and it turns out it's quite a bit more complicated and it's not cut and dry. It is true that when yields go up, stocks technically do sell off, but there's so many other factors, and that's why it's not like so. But I'll go into it. But before I go into that, I just wanted to say like from an investing swing trading perspective, because I don't like I know there's people out there that was trading stuff like some high movers that were kind of like zero substance companies like CCIV. They're like a SPAC and they're gonna supposedly buy a chunk of Lucid, and Lucid like the day before they announce the deal or something like that, Lucid goes out and says, yeah, our car's gonna be delayed by about a year. So they kind of sandbag yeah, it's like kind of sandbag the people holding it. I'm like, it's times like this where it's like, it's really, well, for me anyway, like I want to trade quality, right? Because I
Right.
bought Nvidia, expecting an earnings beat that it'll pop. It didn't pop. It sold off like 15% actually. But I'm not worried because you look at the fundamentals. This thing grew revenue 61% year over year. That's like mind blowing.
Hmm.
So like wherever the stock price is, that people should remember you're still buying a company. You're buying a productive, or hopefully a productive company that will generate revenue and grow revenue, right? So sure, it looks bad now, but next year, 6 months down the line, the story can be completely different, right?
Right. I remember we were talking about that, and you looked at it when it had the earnings after hours because it popped up a little bit and sold right off. And you were going, oh, oh fuck, this sucks. Yeah, what's going on? And I just looked at the chart and I said, what probably happened? Because for anybody who didn't see it, there was, I don't know, a month or so, maybe longer of just consolidation. And then I had this breakout to the upside where it went up like, 30, $40 or whatever it was. And then within a week or two, it came right back down to where it started. And then it had the earnings where it popped up again. So I just told you, I said, don't worry, man. I said, all that is all these people have been chasing everything all year. They just saw that breakout and they bought it like crazy. And then it came back down a little while later. So as soon as you got the earnings on that first push, all those guys are just trying to sell off or break even. So it's nothing bad on the company. It's just all, you got to look at the way the whole market is right now. There's a lot of people just panicking because they're still buying everything that's moving, right?
Yeah, the thing that confused me was like, okay, like I get it. You're a breakout buyer. You're trying to like capture a little bit of the earnings, the breakout, whatever, right? But it's like if a company says they just beat earnings by 61% and you still sold off, like what were you expecting? Like they're making a spaceship or something? Like it's
Earnings
like,
never
hey,
made sense to me, man. Like I don't understand how people trade earnings because I tried that like early on in my trading career and I'd look because that was one of the things I do is I'd look through news in the morning. I'd look, I'd be like, oh, this company reported earnings that was like insane. They thought it was going to be X amount and it was 4 times that and everything's better and their revenue's better and I'd be like, oh, perfect. I'd buy the thing and it would tank 10% right off the open. I'm like, what the hell is this? This doesn't make any sense. And then other companies, and then I've seen other times where it's like, the company's expected earnings are this, and then they're bad, but they expect the earnings to go down, and then the earnings do go down, but not down quite as far as everybody thought they were going to, and then it goes to the moon, right? So it's like, yeah, we're still doing worse as a company, but we're not doing as bad as everyone thought we were doing. So the stock goes to the roof.
yeah, I
So
think I think that's a really good point. Like the stock market, like, because a lot of people point at a company like it doesn't make sense fundamentally. I'm like, yeah, but the stock market really doesn't trade on fundamentals.
no, no. I was listening to a whole thing on some guy, the theory of the efficient market, saying, markets
Oh
are
yeah,
efficient, meaning, in short, basically, whatever the price is, that's the value of the company, and it's fair and it's just. But I mean, like you look at GME, CCIV, like you were talking about. I mean, like, come on, that's not an efficient market at all. Markets are inefficient. So just because a stock is trading at a certain price, that is essentially completely irrelevant to what the company might actually be worth.
yeah. There's a lot of old like economists that are hanging on to that stupid idea that like any inefficiency the market will destroy, and like that whatever its price in the market is its real price. Like, get the hell out of here.
No, not even close. Any beginner who's looked at the markets for 2 months can tell you that's not true.
I know, because like, how long have people been screaming at a stock like Tesla, going, "It's overvalued, it's overvalued, the fundamentals don't match"? I'm like, if it's been overvalued for 12 years, maybe you're the one that's wrong.
Yeah, exactly. Right. It's the same thing. Undervalued, overvalued. It's like at the end of the day, it's whatever people think it is, whatever the market action is, and then if you get enough volume, it just becomes a pattern play, and the company's irrelevant, right?
Yeah, exactly. I think I forgot who said it, but it's like stocks are more like stories. Like people are treating them like stories. If you believe in the story, you believe in the narrative, and that kind of like,
Well, it's
price
like
is where it is. And
buy the rumor, sell the news. That's the whole thing, right?
yeah, yeah, yeah. If you create this narrative, like, oh, Ford's a dying company, but even though fundamentals are there, you could probably just see the stock price start ticking down if people believe
Yeah.
it,
Well, you got to
right?
figure too. Like 90% of people that are, well, I don't want to say 90%, but a lot of people that are trading. I mean, most people don't do research. Like all they do is look at the title of an article and say, oh, Ford is going to be worthless in 20 years because of this reason, and they go, oh shit, let's sell our Ford. They don't do any research. They don't know anything about the company to begin with. They just know that it's Ford. So okay, Ford is safe. Let's put our money
Yeah,
there.
yeah. like I don't know if it's gotten worse or we're just paying attention now, but it seems like the media is so biased with their articles. Because I
Yeah.
think I was talking to you earlier in the week. Like Edmunds came out with this article. They're ranking EVs, and they're saying the headline was Tesla's batteries aren't nearly as good as you think they're. Like they don't have the range. And then you
Yeah.
see like Tesla kind of rank. Like Tesla's batteries are supposed to be the top, but yet their range, their tested range was somewhere like just kind of the middle of the pack.
Okay.
And they basically saying like the cars are saying are supposed to go 300 miles, end up doing like 250, something like that. But like even like a glance at that chart, most people should be like scratching their heads, going, okay, well, if the range is like 20% or so less than it should be, how come the output is exactly what it's supposed to be? Like if a battery is giving you the exact output you're expecting,
Mm.
given a capacity, then how could it range be lower,
Right.
right? And then meanwhile, the top winner was the Porsche Taycan that had a advertised range of something like 300, but it drove like 400, so it did like 20% longer. But it had the exact same power output as the Model 3 that apparently tanked that test. So
That's
it's like,
doesn't make
right?
sense.
No, it's like mathematically, how's that possible, right? And then you read in like the little how they did the test, it's like, yeah, so we don't have, so they didn't use a single track to test the cars. Each car was driven on a different route. So you can't even,
Oh
so it's not even like so it's not a standardized test.
yeah.
And they
How
give you,
fast is it stopping, starting? How windy is it? How many hills is there? Like,
yeah, they don't tell you if it's a mix of highway or street, or what mix of the highway and street is, and they don't tell you the temperature of the day because these are batteries, so the temperature actually matters now, right?
right.
So I think their not numbers are correct, but the way they drove the cars under what conditions they drove the cars are just like really skewed. And then
Yeah.
you look
I
at
sorry, go on.
no, I was just going to finish up by saying, and then you look at who funds Edmunds, and it's like old car companies, right?
Yeah, I got into looking at all that stuff actually. Like when I was first getting big into bodybuilding, I'd see all these like test things. I'd be like, can't think of anything specific, but it'd be like, you got if you eat an orange before your workout, you're gonna be 10% stronger, or like something arbitrary like that. And I'd be like, oh, okay, that's cool. And I kind of just read the headlines for a while, and I start eating oranges before my workout, and I don't notice any difference. And then after a while, I go back and read the article, and it'll say something ridiculous like, oh yeah, it's before you run like a marathon, and it only worked on males between the ages of 30 and 40 who had never worked out before in their life. And it's like, well, that doesn't make sense.
Yeah, I remember reading ones. There's probably like dozens of these where it's like they'll do like some university guys that have nothing to do with actual like strength training will do like a test and be like, yeah, in non-strength trained athletes, if you do this and that, they'll get like a 30% increase. And you're like, first of all, your sample size is like 8 people.
Yeah.
It's like,
Yeah.
how does that even apply? Like,
Yeah. Eight college kids are out drinking every night. And
yeah, it's just like, yeah, they lost weight. Well, you told them to clean up their diet for 3 weeks. You didn't have to do a damn thing after that. They would have, lost some weight.
yeah,
Like,
exactly. That was why, like, oh, what was that I'm going on a tangent here.
yeah,
Was that there's one documentary on Netflix. I think it was all about like how being vegan is the best thing ever, or something like that. And it drove me insane because every single person in that documentary, like one guy was like, yeah, I was 3 months away from dying, and my blood pressure was this and that. And then like, I cut out all meats and I went vegan, and like now I'm super healthy and everything's good. And then like, it kind of goes on through the documentary. And later on, he's like, yeah, like I used to have 2 Red Bulls every morning when I woke up and a box of donuts for breakfast. And I'm like, and then he's like, I'd go to McDonald's every day for lunch. I'm like, oh my God, that's not because of the meat, you idiots. Like
yeah.
someone, and there'd be another woman who'd be like, yeah, like ever since I cut out meat and like everything's just so much better. All I'm eating is plants. And then you find out she's like, yeah, I had like 4 large double coffees when I woke up, and then like for lunch I'd have a bag of chips and like a sandwich, and then for dinner I'd usually just have like a cake or something like that. But ever since I cut out meat and went vegan, everything's so much better. I'm like, I couldn't even finish the thing. I was like, this is the stupidest thing I've ever seen in my life.
I know. I actually refused to watch that thing, but people kept sending it to me because they know it'll work out, right? And
Oh
the one clip I did watch was they interviewed. You probably remember because you watched the interviewed like a what do you call it, a strongman athlete.
yeah,
Because
yeah,
because I'm a hardcore strongman watcher, right? And I know that guy they interviewed. He's not an international anything. He can't even get his pro card. He's like the top 5 in California,
yeah,
first of all, right? And then he was like saying, he made a stupid, absurd comment like, if you want, everybody says they want to be strong like bull, well, bulls eat grass or whatever. And I'm like, well, bulls also have 4 different stomachs that they could digest that shit. We have one. They're not biologically the same.
I know, it's like, yeah, it's ridiculous. So, well, yeah, a little bit of a tangent there, but that's kind of the idea behind it. Is you gotta look at read between the lines and don't just read the headlines to get your information.
Yeah, well, look at the source. So apparently, the conspiracy theory about that is like produced by James Cameron, right?
Mhm.
And the thing was, apparently he had just bought either as a part owner or as like full owner of a company that made vegan protein,
Yeah,
and then he
yeah.
came out with that thing. So it's like,
Yeah, I know. Like I couldn't even make it through the whole thing, man. And then like the worst part was I had people in my family because like same thing as you. They know I work out and stuff, and like, yeah, did you see that documentary? Like, yeah, did you see the different like in the different stuff in these guys' blood, like this and that? And like, yeah, did you see like how much better his cholesterol was? And I'm like, oh my god, like he was eating KFC every day. He was having 6 Red Bulls a day. He was having a box of donuts every day. And then he went completely to eating only healthy stuff and vegetables. Like, obviously, there was an improvement. It's nothing to do with
yeah,
the meats.
no, not at all, not at all. But yeah, back on the topic, I think because I know you wanted to talk about like the bonds and stuff. So I'm still
Yeah,
trying to figure it out.
I know like a little bit about it, but I'm curious to see what you researched.
Yeah, so what I found out was the bond market is actually almost it's 50% to 75% the size of the stock market. So like
Okay.
that's where the real money is. Because so bonds are what's called fixed income assets, right? So stocks are risk assets, it's risk, and then fixed income because the coupon on the bond will tell you exactly how much you're going to get. So it's like it's fixed, right? It's not a variable. And then so like what that means is when you have giant mutual funds, pensions, sovereign funds, these things that where you have a large pool of government employees, you got to secure their future, their retirement. So rather than putting a lot of that money into risk assets like equities, you're going to put it into bonds because because that thing presumably is going to go on forever,
Right.
right? And so you need to be able to fund it in a way that kind of at least not grow it, but design it so that it doesn't lose money in terms of inflation. So then that's why you buy bonds, right?
Hmm.
So that's why that market is so much bigger than the stock market. Um, but a lot of what I figured out, so what, so the thing about the interest on bonds is that the interest is actually fixed; it doesn't move. So this is the
Right.
weird thing. So like, let's say you got a 10-year bond, and you say right now the interest is like 1.5 or whatever it is. The interest is actually not the thing that's not moving. It's not the thing that's moving. It's the price of the bond that's moving. So I'll give you an example. So like, if the Fed sells a $1,000 bond, 10 years, gives you a 2% interest and you buy it, okay, you hold on to that bond, you're going to collect 2% interest on it, right? But what happens is the price of the bond will change. So let's say you want to sell it to somebody buys it from you for like $1,100. So
Hmm.
so that actually takes a percentage off the yield. So based on what you're paying for it. So if you bought that same $1,000 bond for $1,100, then that interest rate falls to 1%.
Okay. Right.
Right. So what happened recently? The bonds were flat or negative. Was that people were buying the bonds for more than the worth, the face value of what it's worth.
Hmm.
Right. And I
So
think, yeah,
yeah,
go ahead.
so when you buy those bonds, then like if you, because you're obviously not getting that interest until the end, right? Because like I had a handful of bonds that like my relatives gave me when I was in elementary school, like $100 bonds or whatever. I'm actually just collecting some of them now because they're like 20-year bonds. But like
Yeah.
you can't collect any of the interest on them until they actually mature, right? So you're basically just trading it like a stock. Then you're just trading the price of the asset.
Yeah. So there's like actual like a lot of bond traders out there. Their portfolios are huge. They're all in the trillions, and they'll just trade these 10 years, 20 years, 30 years back and forth, depending on how the economic conditions are.
Right.
And but so what I've been reading, and the thing is, like the biggest bondholders of the U.S. are foreign countries. So Japan holds the most, I think. Russia used to hold a bunch. China holds a lot, and then the list goes down. But they're usually the ones that are buying these bonds, just to kind of like hedge their own economic condition, right? Because you want to hold U.S. dollars, but not dollars. You want to hold some yield with that too, because every time the U.S. prints money, you get inflation, right? So
Right.
but I think what's been happening is that foreign countries are hesitant to buy U.S. bonds now because they just keep printing that money like it's just nonstop.
Hmm.
And so what happens is if foreign sovereign countries are no longer buying the bonds, then it's up to the capital markets to buy the bonds, private entities, right? Um, and so what's been happening is that even the private entities aren't buying the bonds anymore because they're like, this is dog shit, right?
Yeah, yeah.
So, so apparently apparently there's these guys called the bond vigilantes. It's a myth. It's an urban myth. But what happens is apparently they show up whenever the Fed isn't doing what they're supposed to or isn't playing by the rules. So then they stop buying the bonds or they start selling bonds, and it jacks up the interest rates.
Okay.
And so right now there's what's happening is it's a little bit of like a chicken between these bond vigilantes and the Fed. And the bond vigilantes keep selling bonds and keep raising interest rates, and they're like telling the Fed, "We're not going to buy this dog shit anymore. We're going to make you buy it."
Hmm.
Because the only way
So
the Fed
they're
sorry, yeah.
selling. So they're selling the bonds and causing the interest rates to go up. It's like
Yes.
$1,000 bond, like for a 10-year bond, 2%. Now it's only $800 and it's 2.5% or something like that.
Yeah. So Sam, if you could pull up my screen, I'll show you. This is just like the 7-year bond. This is very recent. So this actually happened on Thursday. The Fed released some 7-year notes, and it was undersubscribed. So this is the demand for it. So the demand actually sells. So people refuse to buy at that price. So people are
Okay.
refusing to buy, and so that's why. So they're not buying, and then so you see the yield go up.
Right.
And
Okay.
so what's happening is that no one wants to buy the bonds anymore because they're afraid of inflation, and b that the Fed won't stop printing money, right?
Right.
Because if you think about it, it's like if you're buying a bond, you're basically buying a debt. So I'm buying your debt, right? And you
Hmm.
get a credit for it. But then if you go and turn around and just go to the backyard, print out some more money, and pay me back what you owe me with newly created money, you just devalued what you owe me.
Right.
And so that's why a lot of people aren't buying bonds anymore. So then now what they're doing is they're looking at the Fed going, "Oh, we're not going to buy. Okay. And then we're going to like tank the stock market as this happens. And then we're going to wait to make you buy it because we're not holding your shit anymore."
But on the flip side of that, though, like if you were a foreign country, then and you're not like as affected by U.S. inflation, then if the bonds drop way down and the interest prices, the yields go up on them, then couldn't you just load up on bonds, get really good yield prices, and then hold those for 10 years, make all that money?
You could, but so that leads into the second issue with it, which is geopolitics, which is the world is in a place right now where so the US dollar as a reserve has been declining for like 2 decades now. It used to be like 80% of the world's reserve. Now it's barely the 60% level. And then
Mm.
you see countries like Russia that just completely went off the U.S. Reserve standard. So now, so Russia actually supplies like most of Europe's gas and fuel, oil needs, and they used to transact in USD, but now they transact in euros. And
Okay.
even to some extent, they're trading in gold now because they're taking those euros and they're buying gold with it.
Hmm.
And then China used to hold a lot of USD, but what they're doing is they've seen what the US has been doing with the USD, so they're starting to unload. But they're doing it really smart. See, what they're doing is they're taking their stockpile of US dollars and they're investing it into Africa. So they know this money's worthless, but they're trying to still extract some value out of it. So that's why they're giving so much loans to Africa. So they're giving this dog shit money that's losing value to Africa and say, hey, you go build your infrastructure and then you pay me back in like another in another currency.
Okay. Huh.
Right. So basically the entire world's kind of ganging up on the US right now and saying we don't like your dollar anymore. We don't want to hold
Yeah.
it.
I mean, like forever. That's just been such a big problem, right? Is that you have one country who's to a certain degree and a fairly large degree influencing and dictating the whole rest of the world, right? Like it doesn't really make sense.
Yeah, so this is a really funny thing that I heard the other day, which actually makes a lot of sense to me. I don't Have you ever heard of the term petrodollar?
Petro, no.
So back right after World War II, the winners, Britain, U.S., they all got together and started this monetary system called Bretton Woods, right? Because the first two world wars started because of what's happening right now, where it's fiat currency is not tethered to gold, so it's called free floating fiat. So they're just floating in terms of value, just trading against each other in the market, and the marketplace kind of dictates the value, and then that's what leads to war because if it's not tethered to gold, then all these countries are just printing money, and it's just kind of like a race to the bottom in terms of
Mhm.
inflation, right? So when Bretton Woods came out, the deal was this: the U.S. dollar would be tethered to gold at $35 an ounce, I think, or was it 24? They changed it, but let's just say $35 an ounce.
Okay.
And then the rest of the world would trade against the U.S. dollar, right? And then when that happened, 1945 to 1971-ish was like the golden era of the United States in terms of the world, actually, because monetary systems made sense.
Hmm.
But what the U.S. did was they still kept printing money, and then to the point where in I want to say 70 something, or was it 1970 something? I think they went off the gold standard. So they said at one point they're like saying, so we're not going to be tethering our money to gold anymore. And then right after that, that's when the petrodollar started. So what the U.S. did was in the 1970s, this was back when the CIA had a lot of activity in the Middle East because the U.S. was trying to secure oil deals. So OPEC, they're the conglomerate that supplies oil. What the U.S. did was they made a deal with them. They said, you're not allowed to sell oil to anybody unless they buy it with U.S. dollars. So that's where the term petrodollars came from. The USD is the petrodollar.
Right.
And so if you think about all the little wars and skirmishes that happened in the last 50 years, it's all around the Middle East. It's all around the oil producing nations.
Yeah.
So what the US has effectively done is basically they're the mafia and they started a protection racket. So they're like, we're gonna protect your supply routes. We're gonna protect your pipelines. In return, you're gonna enforce the fact that you can only accept payment in US dollars.
Okay. So they basically switched from like valuing their money against gold to against oil, basically. But then since
Yeah.
they're controlling the oil and they weren't controlling the gold, then it basically just becomes a monopoly, essentially.
Yeah, so because that's the only way they can kind of enforce demand for U.S. dollars. I mean, if you don't have to buy U.S. dollars to get oil, then what's the use of U.S. dollars, really, right?
Yeah.
So that's what happened. So they're operating this protection racket for like 50 years and forcing everybody to use USD to buy oil. But Russia just went off that. They're like, fuck you guys, we're gonna use euros.
Yeah. Yeah. That's interesting.
Yeah,
Yeah.
so
I
that's
think
what's.
a lot of that stuff's going to change. Like,
Oh,
I think pretty rapidly in like the coming years, just because of all these like Bitcoin essentially, but just all the new platforms and everything, like social media, just the internet, like all that. There's just so much more connectivity everywhere, and it's so much easier to move money around and trade currencies, and all the other economies are growing so fast that it's really just separating the U.S. out. I mean, it's not going to happen overnight, but I think we're definitely in the early stages of that happening.
Yeah, 100%. So that's why the US is like starting to get into a tough spot right now. And like the more I learned about this stuff, the more I realized that their policies start to make sense. Because remember, I told you the other day, like part of Biden's plan, which I thought was stupid, they wanted to raise the minimum wage to like $15,
Yeah, yeah.
right? And then the Fed came out saying that they're targeting a 2% interest rate. So
Mhm.
separately, I didn't understand what these things meant, but once I figured out what was going on in terms of U.S. debt and bonds, it started to come together. So what it basically means is like if a country, like if you're a country and you owe $100,000 to me and a bunch of other countries, right? But we all transact in your dollars. The way you can eliminate or reduce that debt without paying it off is through inflation because
Right.
the value of because the if you create more dollars and the dollar value of your debt stays the same, then in effect you just made the value of the debt smaller, right?
Yeah.
So that's what the Fed is doing. So because the U.S. debt is kind of like untenable right now, it's just massive, gargantuan. So they're trying to inflate their way out of it right now. So if you raise the minimum wage to $15, then and you print a whole bunch of stimulus, like they're doing the 1.9 trillion now. In the summer, they're planning another 3 trillion. So
Right.
you're putting more supply out in the open. You're paying people supposedly more money, and then that's more tax revenue for you, and
Right.
supposedly
Right.
more economic activity, right? So they're just trying to inflate and GDP their way out of that debt right now.
Yeah. So now that $100,000 or whatever that you owe to the other country, it's basically becoming like 60 cents on the dollar, essentially. The rate.
Right.
That's
And
kind of like
that's
what
what.
that article I was reading this morning about mortgages. That's the exact same
Yeah.
thing. I read a pretty interesting article this morning about, because we're just buying another house. I was reading an article that said, should you pay off your mortgage right away or wait? And it's like, it's like the idea behind the article is that you should probably wait. And I was like, okay, let's take a read in this. And it made a lot of sense to me because basically, like, I don't need to get the whole thing, but the thesis of the article essentially was that, you're paying, so you're getting a decent interest rate and you're paying this certain interest rate every month for your, say, 30-year mortgage or whatever it is. But if you just have, your job income and you're paying X amount into your mortgage every single month, then that amount of money that you're putting in, you're still paying all that extra interest. It's still going to take you a long time to pay it off. But if you save that money, then what happens is, it's the exact same thing. Like, let's say, for example, you have a $500,000 mortgage. Then 10 years from now, that $500,000 mortgage, like, obviously you'll have paid some into it, but that now, let's say it's worth $800,000 because of the inflation value of houses. So now you're paying off a $500,000 mortgage on something that's worth $800,000. So you're basically paying like 60 cents to the dollar on what the actual worth is. So the inflation has benefited you in that sense. And then, not to mention, over that course of 10 years, inflation of your country as well, your wage is going to go up because it has to, because the prices of everything is going to go up. So you're going to have more money coming in. And then you can also use some of that extra savings to, put it in the stock market or whatever and invest in other things. And, even if you put it in the ETF or your 8% per year or whatever, if you're putting a decent amount of money into that and you hold that over 5-10 years, that's going to offset all the money that you would be paying into interest anyways. So basically you're getting out of that for essentially break even, or even for more of a profit, if you're utilizing these other things. If you're essentially waiting, instead of just paying off little chunks for 15 years, don't pay any of it until, say, 10 years, use that money to invest in the stock market, save up the rest of your money, and then just pay it off all in one big lump sum at the 10-year mark. And now you're basically paying 60 cents on the dollar or whatever it is because of the inflation value of your house. It could be even more, 50 cents on the dollar. And then you're paying off essentially, half of what your mortgage is actually worth, because you're getting more money from the inflation and all the extra money that you've made in other investments. You end up actually making significantly more money overall, which is, kind of backwards to the way I personally always thought. But I started thinking about it and doing more research. And then, you think about someone like businesses do that all the time, or like, Donald Trump, like, he's probably the prime example. But I mean, think about anyone, right? If someone gave me, $500,000 right now to invest in stocks, like, I could make that $500,000 back and probably relatively quickly. And then I could pay that loan off, and then I still have $500,000. Where if I just have, my own, say, $5,000, to try and get to $500,000 from $5,000 is going to take me a really long time. Whereas if I borrow $500,000 and then trade my way up, I can pay that debt off quite quickly, and then I could still have that original $500,000 in the bank, right? So it's just kind of like, obviously there's the risk that, if you're investing something, you could lose it. But I mean, as long as you're doing everything properly, that's the way a lot of businesses make their money. I mean, you get loans and you just work off those loans and then pay them back, and that's how you can grow a lot quicker. And it's the same idea with the mortgage. I just never thought of it that way, so that was pretty interesting.
Yeah, I find now that the older I get, the more I know, like, the only way you're gonna lose is if you actually play by the book, if you play by the rules, right? Have you noticed that?
Yeah.
Like, if you start thinking about things like kind of outside the box, and you kind of really understand how the inner workings of stuff in the background, like financial engineering, you're like, holy shit! Like, playing by the rules is actually the most inefficient way to do this.
It is, yeah. Like, that's what I'm thinking. I'm like, if I just pay a little bit into it, it's going to take this long. But if I save that money and I invest it, I can turn it into more money way faster, and then still pay that off and still have a whole bunch of extra money in the bank. Like, it's just a no-brainer. But like, nobody ever teaches you this stuff, right? It's not like we don't take any of this stuff at school. I know I think in the States they have like they do like stock market classes, I think, to a certain degree. But like in Canada, we don't have any of that. So like, I didn't even know what the markets really were until I was like in my 20s, basically. And like, outside of that, you just learn how to do everything. I'm just reading random articles, and everything you're reading is like, oh, all you want to do is work, save up, buy a house, and then just work on paying your mortgage off as quick as possible, and then you can start investing and doing all this other stuff. But it's completely backwards. You want to save up and get a house, but then you want to start investing as quick as possible and then pay off the mortgage because you're going to make more money that way.
Yeah, it's so ridiculous. Like, I wonder why. I wonder if that's why they don't teach it in school, because they kind of require us to be morons and just play by the rules so other people can make money.
Yeah, I think it's like, I don't know. I don't know how to say this without sounding insulting, and I hope it doesn't. But I think a lot of people just really don't have the care or like the effort to want to learn any of this stuff. And like, it's a lot easier for banks and governments just to say, like, if you want to be at financial freedom, I mean, for the average Joe, just pay your mortgage, save up, pay your mortgage off, and that way by the time you're 40 or whatever, you have no debts, and then you can work for another 10 years or 15 years, and then you're retired and you're good and you don't have anything to worry about. But like, so if they don't say that, then some people could end up screwing themselves because they just blow all their money, and by the time they're 50, it's like, oh shit, I still have a huge mortgage and I got to retire soon. Whereas like there's a smaller group of people, I think, who actually want to do all this stuff, but it's just not worth the effort to try and teach that on a mass scale, because so many people aren't going to understand it. Sorry. And a lot of people just won't really care to put in the effort to do that. I hope it doesn't sound harsh or anything. I just think that's the reality of society.
No, man, if people take offense to it, it's only because they know it's true, I think.
Yeah. Well, it's like the biggest example that I think I've probably said this on the show, but like, at my old job when I was an engineer, I was out on construction sites and stuff all the time. And like, I don't know why I always remember this so like clearly. It's like just the definition of that type of mentality where like there's this guy on site, he's a construction worker. So, he's making like 80, $100,000 a year, $40 an hour, whatever. He's making decent money. And like, he was like complaining because he's like, oh, I got these bills to pay and this, and like, I don't have any money, and like, I can't do this, and like, I want to go on holidays. And he was just complaining all day. And I was like, oh, okay, whatever. I'm not really thinking anything of it. And then his boss comes over and he's like, hey, we're thinking about working this Saturday, so you get overtime pay. And, so anybody that wants to come in, let me know. And he asked the guy, he's like, hey, do you want to come in this Saturday and work? He's like, I'm not working on a Saturday. Are you kidding me? Like, in my head, I'm just like, so like, you're standing here complaining that you don't have any money. Some guy comes over and says, hey, you can work this weekend, get 1.5 times your average wage, get you more money to solve all your problems. And you're getting upset with him saying, I don't want to work. Like I just couldn't wrap my head around it. I was like, that makes no sense to me.
Yeah, so that reminds me of the study I read a long time ago. It's actually a pretty famous study. They were studying children and trying to see what characteristics could translate into success later in life. And so what they did was they took these children and they're like, and they gave them an option. It's like, and it's a really simple test. Like, you can have one lollipop right now, or if you're willing to wait an hour, we'll give you two. And they found that the children who were willing to wait the 2 hours or the hour to get the two lollipops were more successful in life because they understood the meaning of putting aside your wants now for a bigger return later.
Right.
And so it's like the short-term thinking mentality.
Yeah, it's funny. I was actually talking to my wife about that a little bit today, just on like, we were just talking about like some people we know and stuff like that. And like, even like older people that I've known, like growing up, like at different places I've worked, you see two people that are the same age and they're making the same money for the same amount of time, and their lifestyles are just so vastly different. It's just like, it's all just money management. And, what are they thinking? Like, oh, okay, I got this paycheck. Like now, now I can go out and buy this dirt bike right now or whatever. Or it's like, you could put that into an account for a year and you could turn it into 3 dirt bikes pretty quickly. It's just like, just that whole way of thinking is I think a lot more common, which is, I don't want to say unfortunate, but I think it's just kind of the way that a lot of people think is, everybody wants stuff now. And like, I guess you could argue that I'm like that to a certain degree, because I have a lot of problems, long-term investing. Like I don't really do it right. And like, I can't hold stuff. Like even that Bitcoin trade I did the other day, like I just started trading. So I'm like, guys, like I'm trading super small. Like I was saying to David, I'm just learning how to trade Bitcoin. So like I had 2 trades that I made like over the last week where I lost like $1.50. And then I had this other trade where I got into, and like, I was looking at the 1 hour chart because that's where the pattern set up. And then all of a sudden I just wound up looking at the 3-minute chart. And then on the 3-minute chart, I saw a reversal. So I covered it and I made like $10. So I'm up like $6 overall in Bitcoin. But like, like my patience sucks when it comes to trading because I'm so used to doing the short-term stuff. But like the argument that I have against that just for myself is that, I've been working 4 years, not making any money to get to this point. Right. So it's like, it's a long-term investment in myself and studying and training and, putting money into books and all these kinds of things that I've spent money on and the time I've put into this to be able to do that really quick trade. Right. So it's still a long-term thing, even though the actual outcome and the money is really quick, 5 minutes or whatever, it's taken literally years and probably hundreds and hundreds of hours to get to that point.
Yeah, it's because it's like the trading isn't the real investment. The real investment that happened was you putting the time and money into yourself, into growing your knowledge base and skills, right? And then now it's just paying off.
Yeah, yeah. I was listening to a podcast with a guy who follows a day trader, and I remember he's just like all these different stages. He's like, first it started out like, oh, you're a day trader. Oh, did you lose all your money today? No, you lose all your money tomorrow. It's like, oh, you didn't lose your money today. You'll lose your money next week. And it's like, oh, you actually made money this month. Don't worry, you'll lose your money next month. And then he makes money for a year. And it's like, oh, you made money this year? Yeah, it was a good year in the market. You'll lose your money next year. And then all of a sudden he quits his job, and it's like, oh, you're an idiot. Like, why would you quit your job? And then years down the road now, it's just like he goes out with his friends, and he's like, oh yeah, don't worry, he'll pay for it. Like he makes $1,000 in 10 seconds. Like, get him to pay for all the drinks. It comes easy to him. Like, who cares? Like, get him to pay for it. Let's go on holidays. Get him to pay for it. He'll pay for the holiday while we're on the holiday. But it's like he's like, I've been working 20 years to be able to make that kind of money in 10 minutes.
Yeah, it's hilarious how that works out.
Yeah.
I think I'm gonna pull up another chart just to show. I sent this to you the other day. I don't know why it's not open in Paint. Come on. Oops. There you go. Oh, that's ugly. Well, hopefully you guys can see it.
That's the bull market versus the bear market lengths.
Yeah. So here we go. Because
look at it like that.
Because we had a lot of people this week kind of freaking out and thinking like, oh, I guess they're questioning their head like, okay, what happens if the ride is to a bear market? But I'm like, technically speaking, like the bear markets are all relatively short. The bull markets are quite long. The gains are quite huge, like spectacular. Like this one's like what 500% increase. The most recent one we had was 300% increase from the it was like what, the '08 crash. Like, I mean, these are pretty good numbers. So like you can definitely ride out a bear market. They're not anything to be scared of. Like I did I don't know if I saved it. I did a whole bunch of analysis on my own charts the other day. Let's see, I don't have it here, but so I did a whole bunch of analysis on my own charts the other day, and I was showing you some of that to you, where it's like it was the S&P 500 for the last 120 years, and like the biggest crashes was like the Great Depression crash, late 1920s. That was like an 84% dip, and then the second one was in the 70s. That was like a 50 something percent dip, and that's exactly what we're talking about. That's when the they had, it was called the energy crisis. So there was a shortage of oil, and plus the U.S. dollar was just being completely devalued by how much money printing there was, and so they got off the gold standards, like a whole bunch of stuff. So the stock market crashed then, and the only two recently that was big was the dot-com bubble and the financial crisis. But so what I gathered from those two things was like, basically the stock market, the worst crashes happen due to black swan events, so stuff that we can't see coming. It just kind of like sideswipes us. So that's why I'm not too worried about this bond thing, because not only do we see it coming, it's like being talked about every day, and because of the internet, basically everybody kind of knows how it works. And so like it may take the market a little bit, but I think it's not a big deal because everybody kind of knows not only that it's coming, but the Fed, everybody knows what to do to kind of avoid it. So like it just goes back to this thing. It's like, well, is the Fed going to cave and like start buying the bonds? So like, because I don't know if you watch the news, but they're talking about this thing called yield curve control. I don't know why it's come up recently, because the Fed has only ever done it once, and that was the 1940s after World War II. So yield curve control is basically when the Fed starts buying short-term bonds. And so that's what I was talking about earlier. That's what the vigilantes are trying to force the Fed to do, is to buy the short-term bonds.
Right.
So I don't know if they're going to do that, because the Fed doesn't want to do that, because what happens is they're putting. Actually, I want this to tell this the other day, but so actually there's actually two kinds of money. I didn't know this. There's something called base money and something called broad money. Base money is basically generally only circulated within the central banks and the commercial banks. Broad money is what me and you have.
Right.
And so what happened in 2008 when the Fed, they did quantitative easing, they printed all this money. People were like, well, how come there was no inflation? Well, it's because what the Fed did was they created base money, and that money never reached us. They created base money, gave it to the banks, bought up a bunch of their debt, bought up a bunch of their bonds, and the money stayed within the banks. So it never seeped out into the greater public.
Right.
And so what happens is when the Treasury issues bonds, if the public markets buy it, the capital markets buy it, it's 1 for 1. right? We're taking broad money to buy this debt. It's still like credit and debt, but it's still 1-to-1.
Hmm.
But what happens when the Fed buys bonds is that that money is actually not 1-to-1. It's not created as debt. It's actually bought by real dollars that end up into the economy. And so
Okay.
that's why the Fed doesn't want to do that, because that will actually dilute the money supply. That's what's going to actually cause a lot of unnecessary inflation,
Right.
or,
Right.
or devaluing the currency. So that's why the Fed doesn't want to do that. They don't ever want us to have base money.
Hmm.
It's a really crazy thing that's happening. Like I'm still trying to grasp it myself.
Yeah. Yeah. No, that's all stuff that I'm still learning too. Because like obviously I've only really been doing this for like 4 years, and most of my focus hasn't been on the big, like the larger term scheme of things, right? So this is all kind of new to me as well. But I'm really curious, even just thinking, like just how the markets are going to react in general if we do start getting, well, I would say, if, but when we do start getting the next bull market or bear market, sorry, because we have so many more like retail investors, like guys like you and me, and just the access to information is absolutely instantaneous and worldwide. Like even if you look at 2008, I mean, you know, like neither of us could have gotten half the information we can get now in 2008. It was completely different world, right? So all that stuff is going to be a lot more available, and it'll be. I'm really curious to see how it actually plays out, like whether it'll slow the descent or whether it'll be a lot quicker and sharper and then just stop, or like it's going to be interesting because it really is a
Yeah,
different world.
because there was no Robinhood or any of the zero fee trading either.
No.
Pretty, yeah,
And like even the guys that were like retail traders, it was really like kind of a smaller community, right? Like there wasn't all the platforms, like there was very few brokers, like a lot of people couldn't even trade in their countries. Like it was, it's not that long ago, but as far as the markets and availability and the volume of money that's coming from retail, and it's completely different. Like I would I'd be really interested to see what happens. I almost kind of feel like it would be something like we had, March of 2020, where it's just everybody gets the information so much quicker. And I bet you there's a lot more people that are trying to manage their own portfolios now because they have such easy access to all this stuff. Maybe they'll just sell everything off really quick, and instead of like 2008 where you get this like just slow bleed off for like years, maybe it's just like a really quick bam straight down, and then it just starts up again nice and slow, right? Which could be more beneficial because you get out of your positions quick, and then we're back in a bull market, right? Who knows?
yeah. I definitely think speed's going to happen. So maybe we'll go deeper and higher, or go deeper faster and rebound faster. It just kind of like does that for a little while.
Yeah, yeah. Like maybe we get stuck in like kind of a channel, but it's like pretty dramatic moves in that channel for a while, or
Yeah,
or we just tank really really fast and then just like start up at it's like a 4 or 5 month bear market, and then we just get right back into grinding our way back up. Like it'll be really interesting to see, because this is literally the first time in history that's going to happen with the type of availability and traders in the market, right? It's never happened before.
that's true. That's true. And we were talking the other day, like what our strategies would be in, like, let's say, bear market.
Hmm.
Um, I know. So because I learned to trade during the bear market of Bitcoin,
Hmm.
so I'm more comfortable catching knives and you're more comfortable shorting, which is the polar opposite. It's
Yeah,
exactly the polar opposite, right?
yeah.
So so it's like, so I'm actually I think I'm prepared for a bear market. And did you? I don't remember. Were you going to change your strategy at all?
Yeah, I think like I've never like obviously like I mean 2008 was really the last like bear market we had, so I haven't traded like a full on bear market before, so it'll be a big learning curve for me. But I mean, just in the past couple of weeks, like just seeing days where the markets are heavy. I mean, all I'm really seeing is that I'm just getting a lot less plays, and the ones that I do see just aren't going that far. Because like a good short, you need the stock to spike way up, right? For a short, it's not like stuff's just going sideways and then it just sells off. Like that's not a good short setup. People think like, oh, everything's going down, shorts are going to have a great time. It's like, no, like if you want a good short, you want something to go way up and then you can short it for a big tank back down, right? But you don't get that as much in bear markets. So it'll be a learning curve. I mean, I still know my patterns work. It's just probably going to be, I'm going to be getting a lot less trades and I'm going to be making a lot less money on each of the trades. But that's just, that's the way it goes. I mean, that's the way markets go, right? Changes all the time.
Yeah, yeah. And what's funny, I actually read a report yesterday. There's a company called Strat, and they usually have to pay for their reports, but they released one because I follow one of their analysts on Twitter, and they released one for free. Actually, maybe I'll send it to you later. You might be curious, but anyway, they're bullish about the market. They're literally saying like this is a hiccup. the fundamentals are pretty strong, and
Yeah.
so they had two scenarios. One was a bear market scenario, one was a bull market scenario, and it gave you like their playbook of how to do either. But they were leaning towards saying that this is just a hiccup and the markets will continue going up.
Yeah, I've actually read quite a few articles like that. Like I read most of the consensus I've get just from different articles is that they're saying like 2021 is going to be a good year, 2022 is going to be a good year, and then a lot of them are kind of thinking like around 2023, 2024 is when they're kind of expecting things to kind of go over the hill a little bit.
Yeah.
That's just what I've been reading. I honestly haven't read a lot of articles that are forecasting a big drop right now, which is weird because a lot of like the Buffett indicator and stuff like that. Like there's a lot of technical indicators that people are talking about. All the technical traders are saying, like all the things are getting overextended, this and that, but all the fundamental guys are still saying everything's strong. So they're kind of battling each other right now. I mean, as far as overall markets go, I would listen to the fundamental guys like personally, but it's because it makes more sense long term.
So I read something the other day that kind of threw my brain for a twist, but it kind of makes sense. It's like if you look at the market from the perspective that most people look at it right now, is like it just went straight up. It's overbought, like the RSI is crazy. Like basically, you can just tell the market's like. But then it's like, but that's only true if you measure the value of the market against the dollar, right? So if you see Tesla, it's I don't know what it is, like $700 right now, right? It's quite a bit higher than what it is.
Right.
It only looks expensive if you measure it to the dollar. But if you start measuring assets to other assets, then it starts to look normal. So let's say, because like things like the stock market, art, collectibles, Bitcoin, gold, everything went up last year. The only thing that didn't go up was dollars, right? So if everything's measured against dollars, then yeah, it looks like everything's overvalued. But if you measure everything against each other, they kind of went up in sync. And so the value of things did not go up. The value of the dollar was what went down.
That's a really good point, actually. I didn't think of that.
Right. And that makes perfect sense. If you're going to create 26% of all US dollars ever created in one single 12-month period, the dollar is going to go down, right?
Yeah.
And so I was like thinking, that actually makes sense what you're saying. Like the fundamentals say nothing's overvalued, but how could that be? And then you start looking at it from that perspective. It's like, you're right. Everything relative to each other stayed the same. It's just a dollar that went to the shitter.
Right. So that's why all the technicals are saying that everything should crash, but all the fundamental guys are saying everything's still good.
Yeah, because we've never had a period where actually I even had that chart. Here, Sam, if you could pull it up. This is Fred. So this is the Federal Reserve. This is the Federal Reserve. So M2 is the money supply. Okay. So if you look at all the currency in circulation in 2020, it looks pretty linear, except all of a sudden in 2020 just went boom.
Yeah.
And then if you look, you match that to the stock market.
Yeah.
Right.
That's a good point, actually.
So everything made sense. It's like yes, stocks got bought up, but it got bought up with extra money that shouldn't have existed. So it's technically everything still kind of 1-to-1.
Right. Yeah, that's weird.
It's crazy, right?
This whole past like 12 months has just been really weird, man.
Yeah, and like going into 21, I was like, okay, we're gonna have a recovery, but I'm kind of thinking, is 21 gonna be crazier than 20?
Yeah. Yes.
Right.
I don't know.
Because we're past the COVID stuff, but what if we have all this crazy stock market thing happening the rest of the year? Just kind of like,
I know. That'd be perfect. I'd be fine with that. To the moon, man.
Yeah. So, I wanted to get into portfolio construction.
Yeah.
Because how it came up was because I was kind of debating my old roommate the other day, because we were talking about stocks, and he got into it recently. He's doing quite well, and he's like you. He likes dividend stocks.
Okay.
So I think he got some Apple and Nvidia and some other things, and then I was like, and I was kind of like giving him a different perspective on how to look at portfolio construction. But again, I think it only applies if you have a certain amount of money. I think you need at least $10,000 to start thinking about portfolio construction. Anything before that, like, in my personal opinion, if you have less than $10,000 in like an investing account, if you're trying to use portfolio construction, kind of hedge risk and stuff, all you're really doing is capping your maximum gains.
Because I didn't start even doing that until I had $20,000 because I figured there was no point.
Yeah, I think at that point, if you have less, it's just focus on like a growth stock and just ride that thing high. Like just try as hard as you can to ride it up, because you really need it's harsh to say, but you really do need a large sum of money to play with to kind of like.
Yeah. Well, you did the same thing, right? Like when you first started, you did all your research on Tesla, just went all in on that, and then once you made your money from that, then you started diversifying, right?
Yeah, well, I started diversifying a little bit, but I did ride Apple up quite a bit, and then when I thought Apple had its run, I was totally wrong about that. But when I thought Apple had its run, it went all the way into Tesla, and I kind of wrote that one off. But yeah, I've never had held more than 3 stocks at any given time. Usually it's just 1 or 2 up
Right.
until this point.
Yeah.
But then now, because I reached this point, I started thinking really deeply about portfolio construction. And then, so what I told my buddy was, because he was like 100% in these slower growth, low dividend stocks. So not quite like a bank, but like an Apple or an Nvidia, where you might get a 1% yield, 1.5% yield, but the
you're
stock
probably like
sub
6 or 7% growth on the year for the stock.
Yeah, so it's a nice safe thing. And I was like, how you really want to think about it, and that's not bad, but what you want to think about is taking, like, say you have $10,000 in your portfolio. If you take out just $500, right? It's not going to cost you that much in terms of upside if you're holding Apple. Like taking out, like, what is that? Like 0.5% of your portfolio, you're not going to cut your gains off of Apple, right?
Right.
But if you were just to take that $500 and putting it into a high risk, high probability stock like a Bitcoin ETF,
Mhm.
right? Which might do like 2 or 3 or 5x. Then suddenly your what's that term? Your I'm losing my mind now.
I don't know. I don't know where you're going with it.
Opportunity cost. Sorry.
Oh, okay. Yeah.
Right. So your opportunity cost isn't that high because you're not missing that much opportunity. Then you get a lot of upside in terms of Bitcoin.
Right.
Right. So, and plus, if Bitcoin goes to 0, you taking a 0.5% or like 5% off your portfolio. It really doesn't hurt you that much, right? So I just wanted there's different ways to think about portfolio construction there.
Yeah, it depends on your age group too. Like I know, like that's like anytime you go into a fund or a bank or anything like that, if you're getting someone else to manage your money, then they usually get you to fill out a big form, and it's like, how old are you? What's your income? Like, how steady is your job? Like, do you have a big mortgage? Like, there's all these criteria that you fill out, and they basically, like, they'll recommend where they think you should be. But like, I mean, for the most part, like the younger you are, I mean, you're usually like 70 or 80% in like higher risk stuff, and then 20 or 30 and stuff like Apple, for example. And then the older you get, that balance kind of shifts, right? So like, you get someone who's like in retirement, you're probably going to be like, 70% in dividend stocks, 20% in GICs and bonds, and then maybe like 10% in high risk stocks or something like that, right? So it kind of depends where you're at in your life, but it's like you said, I mean, like, if you are going to start putting your money into the stock market like that, and you have a good chunk of it into a slow growth stock, then you can take little pieces. Like that's what I was doing. I mean, I had most of my money in the slower growth stuff, and then I got a decent chunk of my money in Bitcoin, and then I have like a couple little random side stocks that are super volatile, and I just play with like a few $1,000 on each of those, because I lose a couple $100 here, I make a couple $100 there, and like those stocks are moving enough that I can do that in like a few days kind of thing. So.
Yeah,
That balances out over the slow growth ones.
Yeah, exactly. So like I think I don't know if we're taught in school, but everybody seems to have the same problem or the habit that they have to beat, where it's like we're like in this. We start off with this all in, all out mentality. The portfolio has to be one thing, or if I buy a stock, it's only buy all or sell all. There's not sizing in and out and just
You're like that, man. I'm trying to get you away from that.
Yeah. I know. I gotta start.
I'm never like that, man. I'm like 7 or 8 times in, and then I'm like 15 times out.
It's weird. It's like for my investments, I kind of size in and size out because I almost never position completely, right? It's just something with Bitcoin. I just want to get the hell out of there. Maybe it's because it's volatility. I don't know.
Yeah, true. Yeah.
It's like a burglar. It's like, oh, got some winnings, I'm out. Just like hide.
I know. It depends on the person too, right? Like it depends on the trade. Like for me, I have such little patience that unless I take a little bit off to the point where I know that I'm break even, if the stock goes against me and hits my stop, I'll just, like, any little pullback, I'll just be so stressed out, I'll have to just cut the thing, right? So that's just me. Like, I mean, I know that's, a lot of people will probably say, oh, you got to hold the whole thing because it's, the pattern's perfect, but like I won't if I don't already have some locked in to to cushion myself. And like, that's the way I've always played. And I even had I had a stock last week where I have a couple stocks I'm like swing trading right now. And one of them I've just been like locking in little profits along the way over the past like 3 months. And then I had another stock that I bought a bunch of, and then it just, it was bad and just basically tanked on me. So I sold it off. But all the profits that I'd locked in on that other stock, just, trading in and out of it while it's just doing its thing on a long-term swing, it's basically double what I took on that loss. Whereas if I had just been in that one full size, then, I wouldn't have had any money actually locked in the bank. And then my average would have been down because, it shoots way up, and I'll sell a couple hundred shares and then it'll come back down. I'll buy a couple hundred more and then it goes back up, and just keep buying and selling as it sort of moves along. And you just keep locking in, even if it's like $50, I lock in $50 every few days, just as the thing's moving along. You do that for a few months, and then all of a sudden you have a few $1,000 locked in on the stock. And then if it tanks on you, then okay, great. I got out for a $3,000 profit. Whereas if you didn't lock anything in on the way, it's like, oh, I took a $500 loss,
Yeah, I'm wondering how many people like rode their stocks from the highs and just kind of riding in the red, or just lost some of their profit right now.
Oh, I was talking to one of my friends. He said that he had, was it Sundial, one of those weed stocks? He bought it at like 70 something cents, and it went up to like $5 in a few days. And now I think it's back down to like $1 or something, but he didn't sell any of it. He's like, no, man, I'm waiting for it to get $8. It's like, oh my God, dude, you had like a 600% return. And now you only have only quote unquote have like a 50% return, and you still won't sell it.
Yeah, it's the smash and grab mentality. I don't know. Like I was telling you and Sam, like I sold some. I bought it at that batch. I bought it at 77 cents.
Yeah.
So I was watching it. It went up to because the previous all-time high was $1.36, and I was talking to Sam. I didn't even look at the charts, right? I just knew that the old all-time high was $1.36. It had a lot of momentum on it, and I knew $1.50 is a psychological number. Yeah. So I put a sell order at $1.47 and a half, something like that, and it sold a bunch last night. And it just tanked to like $1.20 now today. I'm just like,
yeah,
that wasn't even technical analysis. That's just like experience, right?
Yeah. I'm the same way, man. Like people like I'll do some of my trades, and like I'll literally I'll top tick my shorts like to the penny. Like, how did you get it that, like, how do you get it right on the penny, like within a cent or two? I'm like, it's just like, it's a combination of just experience and intuition. Because like, I'll see something, I'll look at it, and it'll be like, the line will be like 320, and then like maybe the VWAP line is around like $3. And like, I'm looking at like the volume and stuff like that, and I'll be like, well, like 320 looks like the line, but like, I don't know, 323 just feels pretty good. I don't know why, it just feels pretty good. So I'll put orders there, and then I'll get it within like a penny or two, like a lot of the time. I don't know how. It's just like one of those things, once you've seen it enough times, you start to feel it.
Yeah, I think that's what intuition is. I think intuition is a learned thing. Because me and Sam, we went to the same art school. Sam, did we go to the same program? We did, right? He's not there. All right. So we went to the same art school, and we both learned this concept called visual library, right? Because like you look at some, like a really talented artist, a really experienced artist, they take a white piece of paper and just start going nuts, and you start trying something amazing. You're like, how did you do that? It's because they have what's called the visual library. They spent 10, 20 years studying, which we did. We studied art that we liked, that we questioned. It's like, why does this appeal to us? Is it the symmetry? Is it a negative space? After a long time, you just have a visual library in your head. And so it's not intuition or talent at that point. So you look at a white piece of paper, you know what you want, you just make it happen. Right? And I think that's the same thing with our trading intuition. Like you saw the line and you're just like, I've seen this before. It's not going to hit that.
Yeah. I know what this thing's going to do.
Yeah, exactly. It looks like it should do this, but I feel like it's good.
Yeah, it's going to be a little bit outside of that. It's like even the other day, like my Indus, that little weed stock I've been playing around with for like months now. It had a day like 2 weeks ago. It was at like $2.10 or something like that, and it was like looking pretty good. And I was like, oh, cool. I was like at work, I wasn't paying attention to it or whatever, and then like looked at it after hours, and it had gone all the way up to 250, and then come back down to like 210 or something like that. And I was like, shit, I should have sold some like when it did that big spike and bought in again. But then I looked back and I noticed that last time it had a big spike like that. The next day it had a pretty solid spike again. So I was like, I'm looking at it, I'm like, well, I don't think it's going to get to 250 again. So I was like, I'm gonna put in a sell for 245. That feels right. Like it just feels right. So I put in a sell for 245, and that was literally the top pick on the day. It was 245.
Oh wow, that's
Yeah,
awesome.
literally nailed it to the penny.
I'm gonna guess the second day the volume wasn't like the first day.
No, but it's still like it shot way up. Literally, it hit me right at the dead top
Yeah.
and came back down. I did the same thing on a different stock I was looking at. It was another swing, GRA, that Nano Explorer one I was playing, and I bought it at like 360, and then it started spiking up. It just like took off over like 2 days. It went out like way up over $4, and then the next day it was like up over 450, and I was like, I'm looking at it, I'm like, that's a pretty big move. I was like, I'm gonna put some sell between like 470 and like 483. I was like, I'm thinking that's going to be the top. And I think the top was like 484. So I got all my sells out within a penny of the top.
Wow, that's like, yeah, that was all. Like, I'm guessing you didn't even draw any lines.
No, I just like looking at it. I was like, because like I'm like that's the price that I always play, right? I always play stocks usually that are like less than $5. So like I don't know, I just like you see it enough times, and like I just look, I'm like, all right, it moved this far yesterday. It kind of feels like it's gonna go maybe that far tomorrow, and then you just like put some sells in, right? But that's like I hear people talk about that all the time. They're like, yeah, there's like a level of research and technical analysis and fundamental analysis, and then there's intuition, which is just really after you've seen things 1,000 times over, you just kind of you kind of get to that point. But like intuition, it's not something that's going to be like oh, I'm going to make 100% on this stock because I have really good intuition. It's like, no, all you're gonna do is probably get your entries within a few cents better than you would have previously. Like it's not a life-changing thing. Like everything you need to know, you can learn from fundamentals and technical.
Yeah, I think it's like if you watch football, you're just calling an audible, right? You're watching things play out. You're like, I'm gonna adjust on the fly because I've seen this before.
Yeah, exactly. It's like if I think something's gonna go to $5, I'll be like, 494 kind of feels better.
I got a good story about that. Have you ever heard of a guy named Jim Simmons?
No, I haven't actually.
So he's the boogeyman of the hedge fund investment industry.
Okay.
So supposedly he's actually the most successful hedge fund manager of all time. But they can't prove it. They can't prove his returns because he refuses to something about he refuses to show his trades, and so because it can't be verified, he doesn't qualify for the list.
Okay.
But his returns are still undeniable. Like his returns are so good to the point where his fund is closed. It's only to him, employees, and a few insiders. You can't even buy your way into that thing.
Okay.
So because for a while there, people were calling him a Ponzi scheme, but Ponzi schemes don't work when there's no new buyers.
Mm-hmm.
So it's clearly not a Ponzi scheme. So what happened was he was actually a mathematician, and then he got bored of math, so he decided to go into stock trading. Before that, so he was a mathematician. Then he got a job for the CIA breaking code during World War II. And then after that, and then he said something anti-American or anti-war, so they fired him.
Of course.
So then he decided to go into. I can do a mathematical formula that could predict this shit, right? So he started working on algorithms, and he was like one of the first algorithmic traders.
Okay.
And then so apparently his algorithm for his fund only works if the fund is trading in and out of positions of a certain size, and that's why he's got to cap the size of the fund because it no longer works if you have too much money to play with.
Right.
But I read this guy's bio, and it's like a couple of his early successes had nothing to do with his algorithm. It was intuition.
Oh yeah.
So one of his first partners, it was the 70s. It was the gold rush. So they were playing gold. So they started buying gold, and then gold prices started going up and going up, going up. And then one day he went into the office and he just screamed at his partner. He's like, "I know you love gold, but you're going to sell." The partner's like, "No." He's like, "Fuck you. Sell the gold right the fuck now. This is my company."
Yeah.
Within a day of selling the gold, the thing tanked.
Really?
And it was all based on one phone call, one random phone. He was at home. He wasn't even in the office. He was talking to his lawyer or something, and he was just asking about the lawyer's wife. And the lawyer's wife's like, "Yeah, she's not home. She's selling her necklace." He's like, "Oh, are you guys in trouble? You having hard times? Why is she selling her necklace?" He's like, "No, gold prices are high. She's pawning her necklace right now." And from that one conversation, he's like, "Holy shit! If it got into this point of mania, then maybe it's the blow off top is soon." So he rushed to the office, like, "Sell all the fucking gold we have."
That's hilarious. That's
Yeah,
awesome. When you're right with stuff like that, it's so satisfying. Like it's the best feeling. Just nail it.
right. Like especially when everybody's like against you, and you're just like, "No, this is
Yeah, yeah, it's the best. Like I love it. Like even though like for my trades and stuff, like when they still work out, everything's great or whatever. But like if I have those ones where I'm looking at it and I just have this feeling it's going to go to a certain level that might be a little outside where I really wanted to draw my lines or whatever, and it hits it perfectly and tanks. I'm just like, even if I don't make that much money, I just feel so good about it because I'm like, oh yeah, that's just like I felt that one.
Yeah, because I think like the big wins in the market, like yeah, if you're a momentum trader, it's good to get behind the momentum. But like the other thing about traders is like I think by nature we all kind of contrarian. If the herd is going one direction, we're all kind of looking at the other direction, going, when's this thing going to turn?
Yeah, you
Right?
have to kind of be an idiot not to, right? Especially like the smaller cap stuff. Like you're looking at something and it's say it's a big long play or something like that, and it's closed at $1 and then it opens at $5. Now it's at $15 intraday. Like everybody's pushing this thing up, but like if you're not thinking in the back of your head, okay, any second this thing could just tank like $5 in literally 5 seconds. Like you got to always kind of be watching out for that, right? Like I remember I saw one guy. It was like I felt so bad for him because I've been following him for a while. He's a younger guy, but he was trading a stock like that, and the stock he didn't put a hard stop in for whatever reason. The stock was like it was at like $7 or $8 or something like that. It was up from like 50 cents the day before, so it was like a huge move, really low float, and then it ended up tanking. Like I was watching it, it was literally I think like 2 or 3 seconds. It tanked from like $8 down to like 6.20, and then halted. And then he was caught in the halt, and he was long in like the sevens, and then it opened at like I think like $4 or something like that. So he lost like 25 or 30 grand in like 5 minutes, and he couldn't do it like well basically seconds. So he's just like he was posting about. I felt so bad for him, but like it's
Oh my
that's one
god.
of those things that back to your original point where you always got to be kind of contrarian. I mean, even me, like when I'm in a position, I'm never that married to the position. I have conviction generally, but I'm not over convicted to the point where like if it goes through where I'm in, I'm like like I know that this thing's going to go down because I'm the best, so I'm just going to keep adding higher. Like no, if it does something else, I'm like oh shit, well I was wrong. Oh well, you got to be able to be wrong right away. Otherwise, you're just gonna, anytime you try and get egotistical or think that you're right, you'd be like, no, like the fundamentals say this, or no, like there's no way, like okay, it's only gonna go a little bit higher, but like I've seen this, it has to do this. It's that's when you get into trouble. So you got to be contrarian to the point where you got to be able to cut your losses really quickly and not be too married to anything, especially in what I do. I mean, it's different for long-term investing if you have a really good company, but the stuff that I do can move against you so fast, and you got to be ready to cut it.
No, even investing. I can't remember if I told you, but like I was showing the chart to somebody. You ever look at charts in log or just linear?
Yeah, some of the charts I look at, like not when I'm trading or anything like that, but like if I'm looking at stuff just on the the night after on like stockcharts.com or big charts or something like that, I'll look at it in log sometimes. I don't use that to analyze. It's more so just if stuff runs like way up, it just lets me see levels from way
Yeah.
back. So I'm not just looking at this one giant candle that doesn't have any references. At least I can kind of see more of the history for some of the levels.
Yeah. Yeah. For people that don't know, like linear. So if like if a stock went from $1 to $10 and $10 to $20, it shows it as $10 moves, so that it looks like it's equal. But when
Yeah,
your log chart, like $1 to 10 is like huge, and like 10 to 20 is like nothing, right?
yeah,
So it shows like it graphs the percentage moves. And so like I started to look at all my charts and like I just kind of now. And then what happened was I was looking at Tesla the other day or a couple weeks ago, and it was forming this massive rising wedge on the log chart. You could only see it on the log chart, and I
yeah,
nearly had a stroke because I trade those things. I trade those things hard in Bitcoin. That's when you want to short, right? So then I kept looking at the fundamentals. I'm like, nothing's. This was 2 weeks ago, so before the whole bond scare. I'm like, nothing's telling me this thing's gonna go down, but I'm looking right at this freaking thing, right?
yeah.
So that I literally that same night I panic sold $12,000 worth of Tesla,
Yeah.
And then as the week played out, it's trading within that, 860, whatever, 800, 860 range, right? I'm like, fuck. So I sold another like $6,000 worth of Tesla. And then like as it's getting towards the edge of the wedge, I'm like, am I wrong? Because it doesn't look like it's gonna drop. And then right this past week, you just see like dang, 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 it just drops.
Break
Right?
into the low 600s.
Yeah, I was like, oh shit.
That's really interesting because I'd never even thought to. Have you ever done that before, or you just like randomly decided to?
So I usually look at Tesla and log, but I almost never chart Tesla because it's like an investment, right? I was just like, oh, just buy and hold, just buy and hold. But just because recently I started with the TSFA, I was like, let me do a little swing trading with it. So then I was just bored one night. I'm just studying because when I'm bored, I'm just always studying charts.
Yeah.
So I started like looking at Tesla's history in the last couple of years, and I was looking at this thing and going, wait a minute. So I started drawing a triangle. I was like, oh dear God.
I can just see you sitting there like at 1 o'clock in the morning, just having a panic attack.
Yeah, and then the thing is, if you graph the S&P 500, it's got the same wedge.
Oh, really? On the log chart?
Yeah,
Oh.
yeah. So I'm looking at that. So like, I have one of those moments where I'm like, the technicals are telling me this is ugly, but nothing's happening in the news. Like, it's just one
Yeah.
of those freaky things.
I wonder how valid that would be though on the log chart, because I'm just wondering how many traders actually use that, like to trade their patterns, right? Because normally it's like the more apparent a pattern is, the more it's going to work, right? Because everybody's seeing it, so everybody's going to do the same thing. But if you're getting something that's like really like not, I don't know, maybe a lot of people do, but I'd just be curious if that was just kind of a random fluke or if that's actually something that's worthwhile looking at on the regular.
That's exactly what's going through my mind that whole night. I'm like, how many people are actually looking at this shit? Like, I bet you most people don't even log chart.
I wouldn't think so. Maybe it's just something to keep an eye on stuff that's moved like really, really far, like stuff that's just gone up like crazy over a long period of time, and then you can use that to kind of draw your lines.
Yeah, the only thing I can think of is like those algorithmic traders. I mean, they may not be visualizing it, but their programs are probably noticing the extreme price moves and whatnot. So maybe they're their programs understand what's going on without visualizing. But yeah.
So do you think it's still going to come down further? Because that wedge looked like it could have come down to like 200.
Dude, according to that wedge, 289 bucks. So like that's why I'm still a little.
Yeah, look, I remember you said that to me, and I looked at it, and I'm like, I text you back. I'm like, that looks like it's going to go down to the 200s to me then. And you're like, yeah, I think it could.
I know, so that's why I'm freaking out with this bond thing, because I think that could take it down that much, right? Because tech stocks get sold off first.
Yeah.
So the money's going to leave the tech market and it's going to go into like the Russell 1000, the real hardcore blue chips,
Right.
really safe stocks. So I don't know what to do right now. Just wait and see. This week's going to be crazy.
I know. I just hope there's stuff going on this week. I was bored all last week, man.
Yeah. What do you think's going to happen in pre-market tomorrow? Because like we already saw the news yesterday that the Senate approved the 1.9 trillion. And this week I think they're going to approve the House is going to.
Was that on Friday that news came out?
So it was supposed to happen on Friday. Ended up happening on Saturday.
Okay, yeah. So people will probably get excited. That is good though. I mean, like for the small cap stuff, like there'll be a lot more money in that. Hopefully people keep playing.
Yeah. I mean, so that's like. So I think that's part of what's playing into the bond thing. So the U.S. is going to approve 1.9 trillion this stimulus, but it's not over. There's another 3 billion talked about for the summer.
Okay.
And then so again that goes back to their plan of trying to inflate away their debt, because that 3 trillion is supposed to be for infrastructure. So that's like essentially like government programs. So like building bridges, roads, those kind of things, right?
Right.
So it's like, so I could see why bondholders aren't happy. They're like, you're just devaluing what we're holding.
Yeah. It'll be interesting to see though, because I think a lot of people that like been trading, like all the Wealthsimple Robinhood guys who really got into it last year. I think last week, the past couple of weeks really was their first like real scare they got, because all that just buy anything that's moving thing stopped working very quickly within basically a day. So I think a lot of people are kind of like, oh, I didn't know this could happen. And a lot of people are probably a little bit more wary now.
Didn't it start last week though? Or the week before? So we had like coming out of the long weekend.
It's like a week and a half. It was like mid 2 weeks ago when I noticed it slow right down. Because last week I only made one trade, and then 2 weeks ago I think I made two or three, and they weren't even that exciting.
Yeah, so it's like coming out of the long weekend, we had 4 straight days of slow bleeding, and then just last week we just had like two or three giant like down days.
Yeah, that's what it was. It was the short week because usually when you get a short week, everyone's really, really excited because they're like, oh, I only got 4 days. I got to make all my money I usually do in 5 and 4 days. So on shorter weeks, you usually have like a ton of action. That's why I was kind of surprised that I didn't see very much stuff at all. It was weird. I was like, oh, I guess a lot of people are kind of scared. And then the following week, there was like literally nothing.
Yeah. So actually, because of this thing, I started putting on a few things on my watch list. So they're the you know the VIX, right? The volatility index to BLE.
Yeah. Yeah.
Well, there's ones for bonds too. So I put one for like I think the 5 year for the 10 year. I put a couple of those in my watch list now too. So
Oh,
those
okay.
those play inversely with the markets, right? So when I start seeing that shit going up, my spidey sense is gonna start telling me
Yeah.
to do something.
Yeah, I tried trading some of those for a while. I can't remember them all. Well, there's like the QQQ, the SPY, the VIX, UVXY is one that like kind of run inverse of it, and then there's like JG something or other. There's a bunch of indexes that are like 3 times bear to the SPY, or
Yeah.
3 times bull to the SPY, or whatever, and they're all like in the $30 range or whatever. You can trade. I tried trading those a few times, but it was above my pay grade.
Oh yeah, those are madness. I think I don't know who trades those things, but it's madness.
Yeah, I
So
think all the
tiny
guys,
leverage too.
that just trade the ETFs trade those things. Like they'll just trade them. They trade them all together. Like if you're if you're an ETF trader, you probably just trade all those things just in varying amounts, right?
Oh, okay. I can see that.
Mm-hmm.
Wow, that's interesting.
Yeah, because I was listening to an interview with a guy, and he was talking about how that's how his fund kind of moves things around. Like when the markets are going crazy and stuff, like they'll trade stocks for a little while, and then when they start going nuts, he's like, yeah, then we'll trade the SPY, UVXY, like QQQ, the Dow, like all these kind of things. So I think he's a fund, and he directs all his traders to do that when the markets are crazy.
Wow. This like the more I learn about like trading, the more I realize it's not like uh just black and white, just a couple of traders or some hedge funds. Like this market's gigantic. There's so many strategies and there's like a ton of players. Like
Yeah, and it's growing. So like I bet you now there's probably like 100 times more ways to play the markets than there was even like 20 years ago, just because of how many more people are trading them. Like it's insane.
yeah. So this past week, there's a guy. Well, this past month, there's a guy named Michael Saylor. He's the one who put his company's treasuries into Bitcoin.
Mm.
And then like a week ago, he announced that he raised $1.3 billion. Like he sold bonds for he sold convertible bonds of his company for $1.3 billion that had zero interest yielding on there. And then the only catch was that if his stock went up above a certain price, the buyer of the bond could redeem 50% of the bond for equity in his company.
Okay.
Right. But then I'm thinking about it, like, who the hell would buy a bond that yielded 0% interest? Like, you must really, like, what the hell, right?
Yeah.
So he was in an interview. So that offering started out at 700 million and ended up being 1.3 billion. It was oversubscribed. And I'm like, how is there so much demand? Well,
Mm.
he was saying there are tons of just strictly bond traders and bond managers out there that actually like Bitcoin, but because they can only trade bonds, they can't participate. So when he issued convertible bonds to his company, they can now participate.
Okay.
So then there's a lot of demand out there for this stuff. And I was like, wow, I didn't know bonds was a big thing. Like I just knew equity. I just heard this thing bond in the side of my ear, and I just kind of ignored it. But
yeah, I knew those guys. That was the first thought that came into my head when you said 0%. Who would buy it? Is people that just trade it, like that just swing trade bond prices, right?
yeah, well, but now it turns out like it's because they want exposure to Bitcoin, but because their fund is set up, they can't. But then because he's offering bonds, like that's exactly their wheelhouse.
Okay.
So that's why he's oversubscribed. He got 1.3 billion, and he says he's going to continue trying to buy more.
Right, because then he knows he can get his people into making money in Bitcoin and everything.
Yeah, he's like the way he described. So he's a little bit insane, but the way he describes Bitcoin, like he looks at labor, and he says labor and money are like interchangeable. They're basically the same thing, right? You trade your time for money, and you trade money for time, right? It's like, so if you look at it from that perspective, what you want to do is find an asset that could basically store your time slash money throughout time, throughout the passage of time, that you can hand it out. You can even hand it out throughout like generational wealth, right?
Right.
And he looks at Bitcoin. He's like, this is the best thing I can think of that you could use that could withstand time, that you could pass off through time. So it's like, if you look at a company, it's like, if I have $400 million and real inflation is about 15% a year, so that's money printing and the price of things going up, then I'm doing my shareholders a disservice, because I'm working on this one end over here to generate revenue, the other hand over here, 15% of the value of your money every year.
Right.
He's like, so what I'm doing is I'm going to put it into Bitcoin, this thing that's deflationary, and it works because he's cash flow positive, right?
Mm-hmm.
So I'm going to put the wealth of the company in this deflationary asset, and as time goes on, I'm not only preserving wealth, I'm gaining wealth for my shareholders.
Right. Yeah, that makes sense.
Right. So it's pretty weird the way he describes it.
Makes a lot of sense, though. I mean, like, I think at this point, anybody that thinks it's, garbage or whatever is just kind of ignorant.
Yeah, because it's like a lot of the smart people have back in it, and it's like, well, either they're wrong and everybody else is right, kind of being a little bit ignorant.
Yeah.
Right.
Yeah, I think it's just a generational thing, to be honest. I mean, even JP Morgan, they're saying they're in discussions now about putting 1% of their clients' money into Bitcoin. And there's that article 3 years ago where they said, if any of our people put money in Bitcoin, they will be fired on the spot.
Fired. I know. Yeah. So the other thing I heard about Bitcoin was that a lot of funds have interest in it, or institutions have interest in it, but they can't get into it because it's cheap. And I'm thinking, how is it cheap at whatever, right? And they're like saying it's because, well, if you think about larger pensions or like larger funds, they're not in the millions. Some of them are in the hundreds of billions, but a lot of them are in the trillions, right? So if you're a $1 trillion fund, if you even put 0.1% of your assets into Bitcoin today, you could potentially move the market. If you have to get out of that position, that would suck, right?
Yeah.
So it was a liquidity issue, right? So it's like a lot of them are waiting for Bitcoin to grow to a certain size, and then they're going to start allocating some real money.
Yeah, that makes a lot of sense, because you never want to get in that. If you get in that position, then it's like you said, if you try and sell, then you're selling yourself down to try and get out.
Yeah,
which is really not fun.
Exactly. So like, that's why I think understanding the fundamentals is important, because now you're seeing like Bitcoin's down like 15,000 from its top like just a week ago.
Yeah.
And I was saying, I don't know if I told you earlier, the data was showing a lot of people are starting to sell at a loss now.
Right.
It's mostly like the smaller retail traders, and it's like they're freaking out because they don't know what's going on. The only information they have to go on is the price.
Yeah. But again, it just comes back to, like any investment. If you're putting your money into Bitcoin to invest it, which like I am and you are, like, I don't care what it does right this millisecond. I mean, that's money that I've accepted is not going to be touched for X amount of years. So it doesn't really matter. I mean, yeah, it goes down, maybe I'll buy a little bit more, right?
Yeah, there is a point where I'm going to sell, though, because the interesting thing about Bitcoin is it follows this. There's a guy named Plan B. He's a hedge fund guy, but he's kind of anonymous. He won't let people know who he is, but he's a Dutch hedge fund manager, and he came out with a model about 3 years ago that was called the stock to flow model, and it basically ignores all technicals and fundamentals. It only looks at one thing: supply and demand. So it looks at the supply of Bitcoin, and it calculates the value of the Bitcoin depending on the supply, and it matches it towards at its price currently. And then for the last 8 years, the stock to flow model has predicted Bitcoin's price. It just kind of followed this trend. And what happens is, I'm going to be in Bitcoin as an investor, but there is a portion that I am going to sell at the bull run, because it's very clear what happens is, so every 4 years, the amount of Bitcoin that's mined gets put in half.
Okay.
Get cut in half. And then, so what happens is, for the following 18 months to 20 months that it gets cut in half is what the bull run is.
Okay.
And then what happens is, once that run gets kind of loses steam, then you go into a bear cycle or bear market.
Right.
And so my plan is to kind of sell near the top. I don't have to time it perfectly, but it will be near the top, and just kind of like going to just kind of buy back at the bottom of the bear market.
Okay, that makes sense. So how would that affect it then once they stop mining?
Well, so this is the interesting thing. Right now, the miners are actually 10% of the block rewards right now is actually from the fees, the transaction fees.
Right.
And so so people were questioning for a while. It's like, okay, if you're not getting new Bitcoins as a block reward, and it's only the fees, can the fees sustain the miners, right? It was a question until now, but actually it can, because right now there's about 900 Bitcoin mined a day. There's about 120 to 140 a day in fees. So if you got rid of the 900 in terms of block rewards, there's still quite a lot in fees.
Mm-hmm. Yeah,
and
so
then and then following that is like, so a lot of the central banks are like, oh, Bitcoin's a failed currency, you can't use it as a currency, maybe a store of value, but it's like, that's actually true. It's not a good currency, right? But what people are not understanding is like, well, neither is cash really, right? If you want to move large amounts of cash, what do we use? We use debit cards and credit cards, right? It's those second layer technologies. So right now, Michael Saylor said this. He's like, think about Square and PayPal accepting Bitcoin payments and merchants, right? So what you're going to do is effectively, you're not going to, the network is not going to survive off people transacting with each other. Me and you were going to transact with PayPal and Square, right? And then once a day, Square will do one settlement on the Bitcoin network that's worth like $200 million.
Right.
And then so that's how the network's going to keep going.
Okay.
So it's just like all these major companies that's built Bitcoin, they're going to be the ones doing the major transactions, paying the fees, because it's like right now, like a Bitcoin fee is like about $11. So you're not going to buy a $5 coffee and pay $11 in fees, right?
Right.
But a Square will more than happy to pay that fee.
Okay. Yeah. So then you don't have to worry about it.
Yeah. Yeah. Exactly. So what it's looking like it's turning out, the hope is that Bitcoin is just going to be a store of wealth and what they call pristine collateral. So pristine collateral is like, so let's say you want to borrow some money from the bank, they're going to ask for collateral, a home, a car, whatever it is, right?
Right.
Now, the problem with homes, cars, or even like a stockpile of gold is that you kind of have to take the person's word for what it's worth, first of all. So like let's say you got some gold at home, right? And you use that as collateral, and the bank gives you whatever for your ATV.
Yeah.
So, so what happens is the bank has to trust that you have the gold. B, send people to audit it once in a while. Like if so it's hard. It's a hard thing to use as collateral, right? It's a little messy. But Bitcoin, you can just look on a block explorer and audit a wallet instantly and say, "Yep, it's right there."
Yeah, that's a good point too.
Right. So in terms of value, it's undeniable. It doesn't get hacked. The value on there is what it is. It's like saying, "Oh, if I collateral, it's perfect. You can audit it from the click of your mouse in your home. You know exactly how much I have. You can verify the wallet. Like it's pristine."
Yeah. Yeah, it's just going to limit a lot of that headache that you have to deal with trying to move big sums of money around.
Yeah. So like the future is like going to be one such where it's like a lot of banking and finance might be built around Bitcoin as the collateral thing. So you're going to be buying, people are going to be issuing loans and collecting debt based off Bitcoin. So it's literally going to become what gold was supposed to be.
Yeah, I think that's the idea, because like gold is still so controlled by the states, right? That whole thesis kind of fell apart.
Yeah, not only that, but people are like, "Oh yeah, you can send gold." It's not real gold, right?
Yeah.
And you're still at it's called third-party risk, right? Whoever you're buying that gold from, they're at risk of getting hacked. They're at risk of being dishonest. There's a whole bunch of things, right?
Right.
Whereas Bitcoin is just like hands off. The network is the network. It's right there. You don't have to trust anybody. Just look, it works.
Yeah, exactly. Simplicity.
Yeah.
All right, man, you want to wrap it up here? I think we've been on.
Let's wrap it up here. Yeah,
cool.
I'm good.
All right, thanks guys. Thanks for watching. Remember to like and subscribe. Leave some comments. We'll try and answer your questions, and we'll see you next week.